When you buy a home and you have less than 20% of the purchase price as a down payment, you must get mortgage insurance. Mortgage insurance was created because lenders see large mortgages as a percentage of the property value as being risky, and the insurance insures the lender against your non-payment, making your mortgage acceptable to the lender. That's right, you have to pay an insurance company against the potential of you not paying your mortgage payments to that lender. Mortgage insurance was created to make home ownership possible for borrowers who don't have the means to make a large down payment. This allows you to buy a home with as little as 5% down, and in some cases even a little bit less. There are 3 mortgage insurance companies in Canada: CMHC, which is Canada Mortgage and Housing Corporation, Sagen, which used to be Genworth, and Canada Guarantee. As an aside, mortgage insurance should not be confused with mortgage creditor insurance, which is personal life and disability insurance connected with your mortgage, or home insurance, which insures your home against fire, water damage, and theft, to name a few. I go over the other 2 insurances in other videos. Okay, back to mortgage insurance. The cost is a percentage of the purchase price, which can be anywhere from 2.8% to 4% and beyond for specialty programs, and is added to your mortgage as an upfront cost as soon as you start owning your home. Here's an example. If you purchase a home at $500,000 and you have 5% down, or $25,000, your mortgage would normally be $475,000. However, because you purchased your property with only 5% down, you have to have insurance of about 4% on your mortgage. This is $23,750, and it's added to your mortgage, where the initial actual mortgage balance would be $475,000 plus $23,000 equals $498,750. The problem here is that if you were to sell your property just after you purchased it, you wouldn't get your mortgage insurance back. It's an upfront cost. Basically, if you sell your property right after you bought it, you'd only get about $1,250 back, not to mention all the closing costs that you might have. Okay, so many home buyers see mortgage insurance as a penalty for having a lower down payment. You can look at it that way, but mortgage insurance is actually here to protect your home's value. Remember the 2008 housing crisis in the United States? Without going into too much detail, the US mortgage insurance companies don't get paid their full premium or fee up front. And since they're not as well funded as the Canadian counterparts, they failed to protect their lenders from borrowers not paying or defaulting on their mortgages. American lenders had to sell off their properties pretty quickly, while property prices were as high as they were. This translated into an immediate slashing of property prices as lenders tried to get rid of their inventory or the homes that they held. This didn't happen in Canada. When the United States housing market decreased in value, our prices actually stayed the same and increased quite a bit sooner than expected. The Canadian market was protected against this risk for 2 reasons. The first and most important, it's always been harder to get a mortgage in Canada. We have stricter underwriting guidelines than in the United States, which reduces the risk to insurance companies of paying out. The second reason, and from our example just explained, is that our insurance companies are fully funded from the outset, whereas in the States, you only have to pay monthly for what you use. So the next time you see a home insurance as a penalty, think again. Our mortgage insurance companies saved millions of Canadian homeowners from massive price swings and financial ruin. Thank you so much for watching. I'm Eitan Pinsky at Pinsky Mortgages, a Vancouver, British Columbia-based mortgage team. If you enjoyed this video, please share it with someone who you think could benefit from the information. And if you ever have home financing questions, please don't hesitate to contact me or any of our amazing team members.